All right. We'll talk about financial crisis and large-scale asset purchases of the Fed during the financial crisis. So there is a nice lecture series done by Fed Chairman Ben Bernanke, the Federal Reserve and the financial crisis. This is nice videos to watch. To learn about operation of the Fed and what the financial crisis was about. And you can download the lecture notes and the scripts that Ben Bernanke said during the lecture. So it has four parts. First part is the origins and the mission of Fed, the Federal Reserve after World War II. Part two is. Part three is the Federal Reserve's response to the financial crisis and the aftermath of the crisis in part four. So I want you to pay attention to part three at least. I want you to pay attention to part one so you can see the role of Fed and how it was originated, and then part three, how Fed has responded to the financial crisis. So this was a pretty amazing video I want you to see. There is a really a good scene that I have captured and show it to you in this lecture. Okay, so the financial crisis 2007 through 2008, the Fed responses are captured right here in this log of timeline events. So basically, financial panic means it can be described by these words. During the financial panic, you cannot withdraw your money from your bank, basically. Okay, so there could be a bank run because everyone holds on to their cash. They will not interact with each other. They will not give up their cash. Okay, in normal times, this cash need to flow around the society so that everyone can survive. Everyone can live their living, right? But during the financial panic, since you might lose your money, so you are going to hold on to your money. You will not lend out to anyone. So people who are in dire need of money, so they need to pay back. Someone came at your door to ask for your debt payments and so on. They cannot pay them back. So because they don't have a cash. They have enough capacity during the normal time, but during the financial panic, you are short of money, so you cannot pay. Okay, so let's take a look at what has happened. Pre-2007, banks, the commercial banks, investment banks, went to lose in lending out risky loans. So they make loans that are very risky. Risky loans means high interest payment, high return. Higher the risk, the more payment that you get in return. So they make very risky loans. The risky loans, the interest rate is very high, so you make more profit if it came out okay. So, for example, a strip club dancer got 5 mortgage loans. That means she got 5 houses, right? And when you take a look at the movie Big Short, The Big Short, or a dog. I mean, a mortgage loan was made out to a dog of an owner of a house. Uh, that way, they can create large, number of bad loans, but they hide these, uh, uh, you know, badness by bundling a bunch of bad loans together and make them into a security. And then apparently these securities look nicer and got AAA grade so that people can throw money to buy these bonds. So these are the pre-2009 and 2007 what bank practices were. And May 19, 2005, Michael Berry is the fund manager of a trust fund. Basically, the hero of the movie, The Big Short, he closed a deal with Deutsche Bank worth 60 million US dollars, a credit default swap deal, basically against the subprime mortgage bonds. So he noticed that these subprime mortgage bonds have very bad loans included in it, and the expiration date was coming close, and then he knew that within 1 or 2 years, this will create problems and this will create financial panic. In such a case, stock market will tumble, mortgage market will, be destroyed. The banks who hold these securities will go bankrupt. He knew 2 years before it has happened. So basically, he made a deal with this bank that he's basically shorting the booming market of housing, mortgage markets and housing prices and the stock prices, basically. So basically, in this deal, basically this is short selling of the economy. Basically, the whole economy was very booming apparently, but he knew that this is a bubble, and then he short the market, the whole market. Basically, this is kind of a premium that he pays with this deal. When the market comes down, then he make a lot of money. Okay, so it is a short selling. Okay, and in the till 2006, up to 2006, at 2006, in the year 2006, house price peaked and mortgage loan delinquency started to rise, and basically, some of these bad loans made out to unqualified, people who cannot make payments, in a stable manner, they go bankrupt. And when they cannot pay the mortgage payment anymore, the the security that include this mortgage investment goes bad, and when this security goes bad, then the investment bank who hold this security goes bad as well. So they go bankrupt basically. So it started to happen in with this event right here, April 4th, 2007. A real estate investment trust is kind of an investment bank called the New Century filed for bankruptcy. And then after this starting event, lots of big companies, mortgage companies, went bankrupt. Another one after another one. And there is a bank run occurs at a Northern Rock, British bank, also happened. And since these events happened, panic spreads out in the commercial banks and the Wall Street, and everyone holds on to their cash. They will not lend them out, and cash disappears in the market, then you cannot get the money to pay for your debt. And when the term of your debt approaches, you cannot but go bankrupt. You cannot but commit defaults. When the defaults occurs, then your organization has to cannot but file for bankruptcy. So defaults occur one after another. And September 18, 2007, Fed finally decided to step in as the lender of last resort, and basically they provide liquidity to the market. They inject money, try to inject money into the market by lowering interest rate, which was peaked at 5.25%. It went down to 0%, but the panic continued. People still hold on to their money. They will not interact with each other. And the stock market tumbled, bank run continued, and finally the Lehman Brothers, which is the biggest, one of the biggest investment bank in the Wall Street, filed for bankruptcy. Then after Lehman Brothers bankruptcy filed, the U.S. Congress enacted emergency bailout initiative, and worked with the Fed, and the Fed started to saving other bankruptcies. Um, I mean, saves other big investment banks like AIG, Goldman Sachs, and Morgan Stanley. Each one of them were on the verge of making defaults. Basically, the argument was, again, these banks are too big to fail. If the government leave them fail, then it will encounter chain reaction of defaults and avalanche of bankruptcies, and financial market will collapse, and the economy will collapse following it. Okay, so in September 2008, Bernanke requested 700 billion US dollars fund to acquire toxic mortgages. So like I told you, Fed can purchase U.S. securities and mortgage-backed securities. So even though these are bad ones, Fed can do that in order to make the financial market stable. Okay, he said that if we don't do this, we may not have an economy on Monday. That's what he said. So that's what has happened in the financial crisis. And we want to pay attention to the policy tools the Fed has used during the financial crisis. I don't have the time for all the tools, but one of the most dramatic tools that Fed has utilized during the crisis is called LSAP. LSAP is large-scale asset purchases, what is usually called quantitative easing by Fed. Basically, Fed purchases U.S. bonds and mortgage-backed securities in its open market operations. So basically, the Fed can lower the mortgage interest rate. The Fed can lower the short-term interest rate, but in order to lower the mortgage interest rate, it has to purchase mortgage-backed securities. These securities called bonds, offer a fixed rate of interest. And the yield of these bonds, the return of these bonds, um, which is measured based on the amount of money to purchase this bond and the amount of interest money that you will get. The ratio of of these two is basically the yield rate, right? The amount of money you will earn divided by amount of money that you invested to purchase these bonds, right? The yield rate uh, goes down if the denominator, which is the purchasing price of the bond, okay? So how do you make the purchasing price of bond goes up? How does the Fed need to do in order to increase the price of bond so that it can reduce the yield rate of these bonds so that it can lower the mortgage interest rate. So that was the operation that the Fed aims to achieve. So basically, in order to do this, Fed goes to the open market for the mortgage-backed securities, and it purchases uh, these assets. Basically, if Fed purchase these assets, then there will be less number of these assets up for selling, since the supply of these mortgage-backed security is reduced, then the number of people who want to buy, then the price has to go up. Then if the price goes up, the yield rate of this bond goes down, and then Fed can achieve its goal of lowering the long-term interest rate. So it lowered the long-term interest rate, and the mortgage interest rate, which is tied to the long-term interest rate, uh, is lowered as well. Since the mortgage interest rate is lowered, people can refinance their home mortgage. So basically, people who are on the verge of making defaults, they can be saved because they can get cash by refinancing their home. So that is the aim of the Fed during the financial crisis. They purchase large amount of assets. So large scale asset purchases done during this time period, right? And this is the Fed balance sheet in terms of assets. So they acquire this much assets during the financial crisis. So it went from 1 trillion US dollars to almost 3 trillion US dollars. So 1 trillion US dollars amount of assets were the pre-financial panic. As the total number of assets pre 2008 era was 1 trillion US dollars. But after the financial panic during 1 to 3 years, it went to 3 trillion US dollars. So the Fed had purchased uh, twice the number of amount of assets that he had, obtained for the long time. I mean, uh, so it went from 1 trillion US dollars to 3 trillion US dollars. So Fed has purchased twice the assets that he had previously had. Okay, it has previously had. So this large amount of assets purchased during a short span of time. Okay, and the big question is, how did they pay for these asset purchases? When one wants to purchase something, then he needs to pay money, right? But where is the money that the Fed get to purchase these assets? Here is the words by Fed Chairman Ben Bernanke in his college lecture series. He said that they just increase the electronic balance at the Fed. Each commercial bank have a reserve account in the Federal Reserve Bank. They just increase this amount, just increase the numbers, then they can create money. So that's basically it. Okay, so Fed is not printing money to acquire these assets. All they had to do is increase the balance of a commercial bank uh, by $2 trillion. So then they basically create these 2 trillion US dollars and given to commercial banks in exchange of mortgage-backed securities. So mortgage-backed security is going to appear in the liabilities, the asset side of the Fed, and the liability side, they have the same amount appear. So this is the uh, uh, Federal Reserve balance sheet, liability, and the capital. So this is the amount of US dollars in circulation, Fed Reserve notes in circulation, and the reserve balance increased by this much, and a little bit of others. So basically using these increase in reserve balance just in the computer account, by increasing the numbers, they can create US dollars and give this out to the society. In fact, to the banks. Bank utilize this money to so that they can lend out to people and lend out to other banks and institutions as well, so that using this new money, the financial panic can be relieved. So this has worked. Basically, financial crisis has stopped because of these activities of the Fed. And after that, the U.S. economy has started to booming again, and it is again, you know, uh, uh, going in the phase of overheating, so that it becomes a bubble these days. So that people today worry about bubbles, right? Especially after the COVID-19. I will talk about this more in other parts of my lecture in the future, probably in the the third week of this semester. So that was what has happened, and then we can think about causes of financial crisis in short, phrases, so that we can sum them up, quick. So first, there were investment banks predatory lending. They make risky loans, and they made risky securities made of these bad loans, and they get government guarantees so that they get AAA grade. So people buy them. So all these government programs of guaranteeing, payments. If you go delinquent, I will pay for you. The government will pay for you. So don't worry about it. So these type of things were the part of the reason. And another thing that we have to emphasize is the moral hazard of people in the bank, people in the society, they didn't evaluate their ability to make payments. They buy large houses with swimming pools, and then not only one, two or three, with the expectation of booming, the house price going up again and again. So they are very greedy and morally very hazard. Uh, so those are the causes of financial crisis. And then what was the results of financial crisis? So Fed inject large amount of money into the society. It'll create another bubble. And during the process, rich got richer. Banks and elite people in the bank make these financial products, making risky loans. But when they actually got failed in doing so, they were bailed out by the Congress and by the Fed. Why? Because it is a too big to fail problem. Basically, if the government let them fail, it makes a ripple effect of defaults, chain default. Then the whole economy might collapse. So that was the reason for bailing them out. And then also they did not get punished after the event. After the event went, only one banker has been jailed in the United States. So rich has gotten richer, and all the money went into the society, uh, come back to the bank, and the bank made the investment in the stock markets and house securities and so on. So the people who are rich, who have these assets in large amount, has gotten richer. Okay, and as you have seen in my chart uh, about inequalities after the Nixon era, Nixon shock. So basically, there are evidence that greater inequalities have preside all over the world because of money injection by central banks. So here I'll give you a scientific evidence for this claim that 1% versus 99%. Basically, this paper shows data analysis from 1920 to 2015. It says that the money made from monetary policy by central banks go to hike the price of assets, but not to wages. So basically, that is the bottom line of what has happened. So the monetary policy and the top 1%, evidence from a century of modern economic history. So these are the authors, and basically they are affiliated with the Deutsche Bank. This paper examines the distributional implication of monetary policy from a long-run perspective, with the data spanning a century of modern economic history in 12 advanced economies between 1920 and 2015. Uh, We employ two complementary empirical methodologies for estimating dynamic responses of top 1% income share to a monetary policy shock. Uh, Vector autoregressions and local projections. So these are the techniques. So we notably exploit the implications of the microeconomic policy trilemma to identify exogenous variations in monetary conditions. So here is the bottom line. So the obtained results indicate that expansionary monetary policy, money injection into society, that is what it means, strongly increases the share of national income held by the top 1%. Okay, our findings also suggest that this effect is arguably driven by higher asset prices and holds irrespective of the state of the economy. So this effect, inequalities, top 1% get all the benefit of money injection, um, is happening throughout the whole world because the U.S. dollars is the reserve currency. Once the U.S. dollar is devalued, then Korean won, euros, all of these other currency has to be valued. So otherwise these currency goes higher in value compared to U.S. dollars. In such a case, they cannot export their products to the United States, which is the largest global economy in the world. So since they cannot export goods and services, they cannot make money for their economy, so they have to devalue their currencies as well. So all of these things added to the money injection into the society, in terms of a global economy, and then the inequality occur everywhere in the world. And then because of awareing these things happening, there are people who advocate that reform need to be done. And one of them is Bernie Sanders. And in terms of Bitcoin, basically, Bitcoin allows the brokering of trust to machines and away from human intermediaries such as bankers. Why? Because banks and governments fail to broker trust. Ordinary people have grown worry of centralized power and seeking of alternatives. Okay, so these are what is happening, what has happened, and after the aftermath of the financial crisis. And then there are other advocates which says that the financial crisis, expansionary monetary policies are the jobs of government. So we need to have a small government. We need to have a free market capitalism. Basically, we need to encourage entrepreneurship. Making money means creating jobs with the new goods and services. That's the real money. So we need to go back to the gold standard. Uh, there are certain people who claim such things. And there is, now I want to summarize what I have started with: economy, currency, and government. So people want an ever-improving state of self, and their economic condition, compared to what they have enjoyed in previous years, have to be improved each year. That's what their expectation is. So there are government. The government has a leader, the president, for example. The government or the president who would like to get re-elected make promises. I will make your lives better. So in the beginning, food and house, energy and water, safer environment. But this list of requests grows one after the other. Once they achieve these basic needs, they go for higher needs, which is more difficult to fulfill. For example, I want to work less but improve the lifestyle with leisure and equal opportunity for limited resources like educations and yeah, land and busy areas and so on, and the improved education for children and free education and so on, free college education and so on. And the results, politicians need to get re-elected, uh, so they make empty promises which can be fulfilled only by money creation. So when they got elected, money is poured into the society. Government guarantees growth, uh, and the debt is actually growing because this money generation is done by securities of a sovereign nation. And these securities are nothing but IOUs. So IOU means I will pay this back with the taxes that the nation will earn in the future. Who are going to pay the taxes in the future? The future generations. So they continue to make debts and then using these debts to create money and pour them into the society. And then when they do that, asset price is soaring, and more people seek money trading because all these booming markets are stock markets and so on, and less people are wanting to work because work has less value than trading than money trading jobs, right? So less production of goods and services, entrepreneurship is reduced, and inequality grows, and the society in which honest work is less valued, and middle class people shrinks. And these are the results that the United States is experiencing today. And then uh, it is importing this type of culture to other nations as well. So all the other nations, there are certain areas of land that are favored by the people, and those places, the asset prices getting higher and higher, and the U.S. market, stock markets are the favored biggest markets in the world. So uh, try uh, people put their money into this market uh, uh, and so on. Okay. Um, so here is the conclusion for today. Today there are many issues which make us to think. Um, Currency is not money anymore, and basically they are debts by sovereign nations. And when money is poured into the society, it creates bad effect uh, rather than a genuine effect of making the economy healthier. Okay. So with from the frequent financial crisis people experience, trust to government, especially the U.S. government, has been greatly reduced, and people are grown worried of budget deficit and currency expansion. and issues around Bitcoin are therefore decentralization of power, decentralization of money generation power. Let's give this power back to the people. That's what they are claiming. And reforming the modern financial system. And we aim to reduce inequality so that more people work in the real economy where valuable goods and services are produced. And then more people enjoy these goods and services and enrich their lives. Less amount of work, but more higher quality of lifestyle can be supported by making the money, real. So the issues that we can entertain at this point is, should we go back to the gold standard? Or could we adapt a new solution for these problems and make the society a better place to live? And what do you think? Are the Bitcoin prices getting higher and higher? Uh, these are the issues that we can think of uh, you know, when we come to study a new form of money, which is Bitcoin. Okay. All right. I think I should stop at this point.